Many traders and investors use indicators to spot market patterns and trends, and most of these indicators fall into two types: leading and lagging. A leading indicator is a tool designed to anticipate the future direction of a market in order to enable traders to predict market movements ahead of time. In theory, if a leading indicator gives the correct signal, a trader can get in before the market movement and ride the entire trend. However, leading indicators are by no means 100% accurate, which is why they are often combined with other forms of technical analysis. A lagging indicator is a tool that provides delayed feedback, which means it gives a signal once the price movement has already passed or is in progress. These are used by traders to confirm the price trend before they enter a trade. These indicators are commonly used by trend traders. They don't show any upcoming price moves, but confirm that a trend is underway. This tends to give traders more confidence that they are correct in their assumptions, rather than providing a specific trigger for entering the market. So what's the difference between leading and lagging indicators? The most obvious difference is that leading indicators predict market movements, while lagging indicators confirm trends that are already taking place. Both leading and lagging indicators have their own advantages and drawbacks, so it's crucial to analyze yourself with how each works and decide which fits in your strategy. Leading indicators react to prices quickly, which can be great for short-term traders, but makes them prone to giving out false signals. Conversely, lagging indicators are far slower to react, which means that traders would have more accuracy, but could be late in entering the market. Lagging indicators are tools used by traders to analyze the market using an average of previous price action data. As the name implies, these indicators lag the market. This means that traders can witness a move before the indicator confirms it, meaning that a trader could lose out the start of the move. Many consider this as a necessary cost in order to confirm if the move gathers momentum. Others view this as a lost opportunity, as traders are missing getting into a trade at the very start of the move. A lagging indicator often makes use of price as an input variable and in most cases requires a longer look-back period in order to ascertain trends. Even with the delayed feedback, many traders prefer to use lagging technical indicators, as it helps them to trade with more confidence by validating their trade decisions. Usually, traders make use of two or more lagging indicators to confirm price trends before entering the trade. This can be viewed as a conservative way to trade, but don't let this draw you into a false sense of security that you can make the best decisions and make money consistently. Let's look at a classic example of a lagging indicator, namely the moving average. In this setup, we added a 50 period and a 200 period moving average to trade a golden and a death crosses, which are bullish and bearish crossovers of the 50 and the 200 simple moving averages. Generally, the asset is said to be bearish when the 50 SMA crosses below the 200 SMA, and bullish when the 50 SMA crosses above the 200 SMA. In this chart, notice that the signals generated by the bullish and bearish crossovers of the two moving averages occur very late. In the first signal, for example, if you enter short after the bearish signal, it would be a losing trade. This is because by the time price moved lower and the moving average reacted to this, price already fell significantly and started to pull back higher. I've also read a lot of false information regarding the RSI, the stochastic, and other momentum oscillators, which were associated with the leading indicators type. No, they are not leading indicators, although those indicators will generate a lot of good signals if traded correctly. They will not lead the price. Just because they tell you how overbought and oversold the market is, this doesn't mean that they are leading the price. Now, I'm not saying that you shouldn't use lagging indicators because they can help you to make informed decisions. Just remember that lagging indicators can only provide today's value based on the historical data. Since these indicators lag the price of the asset, a significant move in the market generally occurs before the indicator can provide a signal. The truth is that almost every technical indicator is a lagging indicator. Moving averages, MACD, the RSI, the stochastics, you name it, are lagging. First, there is a move in price. Then, sometimes later in the game, the indicator signals a buy or sell signal. They lag behind market action. They give signals after the fact. It's really important for you to understand how the lagging indicators work and how the data is compiled before incorporating them into trading strategies and risking capital on those strategies. Always remember that the price moves indicators, not the other way around. This is why they always look profitable when you look at them at the left side of the chart, when the price action is already unfolded. Leading indicators are different. Leading indicators are indicators able to precede the price movements of an asset due to their predictive qualities, while lagging indicators follow price movements and don't have reliable predictive qualities. Leading indicators are able to anticipate when major moves in the market would occur. A leading technical indicator is designed to anticipate future price moves in order to give you an edge. As magical as it sounds, a leading indicator relies upon the most common variable, price. A leading indicator will allow you to anticipate future price movements, and therefore you will be able to enter trades potentially at the start of the move. The downside is that traders are anticipating a move before it actually happens, and the market could move in the opposite direction. As a result, it isn't uncommon to witness false breakouts or signs of a trend reversal that just end up being minor retracements. So which indicators or tools I consider to be leading indicators? Well, pivot points are leading indicators. Pivot points are levels that were used by floor traders to determine directional movement and potential support and resistance levels. By analyzing today's high, low, and close, you are able to calculate the next day pivot points, as well as potential support and resistance levels. Part of what makes the pivot points so reliable is the fact that they are based purely on price. Plotting these levels allows you to know in advance some key levels for the next day. You know that if the price reaches this area, for example, there will be a reaction, a rejection, or a breakout. Fibonacci retracements and extensions are also leading tools. This means you can decide on the likely direction ahead of it happening, as compared to a lagging indicator, which only predicts movements after it has already started to occur. With Fibonacci as a leading indicator, you will see the entry point and place an order in advance of the market reaching your desired level. Other traders also consider volume as a leading indicator, but only in conjunction with price. Trend lines, support and resistance levels can also be considered leading tools because you can plot them on your charts and find levels where the price can react. Leading indicators tell you ahead of time where the market is likely to find support and where the market is likely to find resistance. Now, should you use leading or lagging indicators? For traders, it is often the dilemma of finding a balance between them. Rely only on leading indicators and chances are you will see a lot of false signals. Rely only on lagging indicators and you will likely enter late and hold on your trades too long and give back most of the profits. Traders looking for fast signals will tend to favor leading indicators. Traders seeking a greater degree of confidence will tend to favor lagging indicators. The trick is to achieve a proper balance by mixing leading and lagging indicators across timeframes. If you can accomplish this objective, you can come up with a trading approach which is far superior to using either of the two exclusively. With these obvious drawbacks, it is best to develop a trading strategy that combines both leading and lagging indicators. For example, you can use a lagging indicator like the 200 exponential moving average and the leading one, the pivot points. First, determine the context for the trade using the lagging indicators. So if the price is below the 200 EMA, we have a downtrend, and above 200 EMA, an uptrend. Then, establish the entry using the leading indicator, namely the pivot points. You can buy a pullback, for example, at the central pivot point when the market is above 200 EMA in the direction of the trend. You can continue to use the leading indicator to find the stop placement point, meaning your stop loss order. In the case of this uptrend, this would be below a substantial support level, maybe below S1 level. Or you can use a Fibonacci retracement and an oscillator, like the stochastic, again a leading and a lagging tool side by side. You can enter after a stochastic divergence or an oversold stochastic, when the price rejected an important Fib level. Again, try to find the proper balance by mixing leading and lagging indicators with the aim of stacking the odds in your favor. If you learned something new and found value, leave us a like to show your support, subscribe to our channel, and click the bell icon to stay in touch when we upload new videos. Until next time.